Hello everyone, my name is Nrupin and welcome to my video blog. In this video we will try to understand the role of price theory in technical analysis. Before we move ahead with video, I would like to inform this is second video in technical analysis series video. If you haven't watched the previous video, you are requested to watch that video first. You can find link to previous video in description. While learning technical analysis, the first thing that we usually learn is price theory. Dow theory is the most popular one, but there are also other theories like price cycle theory, crowd psychology theory, market cycle theory, Elliott wave theory, Bayesian area theory, and theory of contrary opinion. All these price theories state one and the same thing but with different nomenclature. Therefore, all books keep their focus on any one of them. Knowing all of them is not compulsory. Now, if you will search for economic cycle in Google Images, you can expect to see results like this. All these diagrams of economic cycles represent result of increased and decreased demand with respect to different aspects of business, GDP, economy, cash flow, sales, etc. This is French doctor and statistician Clément Juglar. He was first to introduce idea of economic cycle. The goal was to understand overall trend of GDP over long term. Economic cycle is also known as trade cycle or business cycle when applied to understand overall trend of market with respect to demand of products and services. The trend with respect to economics is usually used to refer what is demand in current market situation, whereas in statistics, trend usually points the direction. For example, if we say blue shirt is trending, then it means demand for blue shirt is increasing in market. Whereas when we say our sales are trending, then it means our sales figures are increasing. The concept of uptrend and downtrend in technical analysis are adopted from application of economic theories and statistics, where uptrend represents period of increasing demand, whereas downtrend represents period of decreasing demand. Keep in mind, trends happen with respect to changes in demand, and we plot these changes on chart with help of statistics. By definition, statistics is branch of mathematics which deals with data collection, organization, analysis, interpretation, and presentation. We know that security prices move a lot. While charting, what we do is we collect this price move data, organize it in first quadrant, and present it with help of lines, bars, candlesticks, point figures, Renko or Heikin-Ashi on chart. So this is how usually a chart in technical analysis looks like. On x-axis we have time and on y-axis we have price. Now we have data collected, organized and presented. Now we have two things left, analysis and interpretation. Keep in mind, analysis is always going to happen with respect to demand, and with help of analysis, our goal is to figure out what can probably happen after some particular event. With help of economic cycle, people tried to come up with rules to interpret this data. In time before internet, information propagation was not as fast as today. Therefore, people who came up with interpretation also came up with different nomenclature. Price theories are nothing but methods to interpret data on chart for analysis. Charles Dow was finance journalist. His theory became Dow theory. Ralph Nelson Elliott was accountant. He came up with Elliott wave theory. Stan Weinstein was also from finance and business discipline. He came up with Bayesian area theory. Behavioral economics came up with crowd psychology theory. Scholars of countries which followed lunar calendar came up with lunar cycle theory and price cycle theory. Personally, I use price cycle theory. Therefore, in this video too, we will focus on price cycle theory. Price cycle theory states price moves in form of cycles. Each price cycle has a bullish half side, better known as bullish half cycle, and a bearish half side, better known as bearish half cycle. In ideal conditions, bullish side equals bearish side. When market is bullish, bullish half side becomes bigger than bearish half side. Similarly, when market is bearish, bearish half becomes bigger than bullish half. Each price cycle is formed of 3 or more smaller price cycles, better known as minor price cycles. The first minor price cycle helps in detection of trend of major price cycle. The second minor price cycle is usually the most profitable minor price cycle in major price cycle. And as trader or investor, you take position on birth of second minor price cycle. Condition remains same for downtrend too. Each minor price cycle is major price cycle and each major price cycle is minor price cycle. Either you are looking at major price cycle or minor price cycle depends on time frame. Finally, retracements are 33 to 50% of the trending price move. Now with help of these rules of interpretation, let's try to understand what is happening on chart of IPA PPM. Price broke previous high and created a new high and then made new low which is higher than previous low. The bullish half side is bigger than bearish half side, which means we are probably in uptrend. Now each major price cycle is formed of 3 or more minor price cycles, from which first is used to detect direction of trend. Since this move helped us understand prices are in uptrend, this is first minor price cycle. Finally, we are supposed to take position on birth of second price cycle. In our previous video, we learned a motorbike is well-defined concept. Similarly, price theory is well-defined concept. It tells us what to expect from price moves. Concept of trends, support and resistance can be used to take buying position based on price theory. For example, when resistance broke and prices came back to broken resistance, I bought it here. But when prices failed to break above resistance, I booked profit and waited for it to bounce up successfully again. Recently, when prices showed reluctance to break support, I bought it again here. Honestly, you can trade and invest on chart purely based on price theory, concept of trend and support resistance. If making buying and selling decision based on these concepts is difficult, then you can use indicators as assistance to help you make buying position. For example, we could have used super trend to make buying decision. Here you can see super trend has generated buy position exactly at same place where I made buying decision. The result wouldn't really have changed, either you would have used price pattern, RSI, candlestick pattern or structure. Depending on how you choose to analyze, your buying position may differ a little, but in most cases there wouldn't be any difference in buying position. With similar logic, I also made buying decision on Praj Industries. Keep in mind, there is no guarantee that these investments will succeed over time. But as per price theory, second minor cycle is most profitable cycle to invest in. Therefore, I invested as soon as I saw birth of second minor cycle. It's fairly simple. Take interpretation from price theory and make buying and selling decisions. You can make buying and selling decisions based on support and resistance, or you can use indicators. I hope that helps. In case you are interested in learning how to trade with help of technical analysis, you can join our course on Udemy. Link to course is in description of video. In next video, we will take a look on how support and resistance as concepts were adopted from economics. With that said, thanks for watching this video and see you in next video.